Hello friends, welcome back to our channel SNK and Company. I hope all of you are doing well. Let us begin this week's detailed update covering some very important developments under the Income Tax Act, GST laws, and other key corporate laws. These judgments carry significant implications for taxpayers, professionals, corporates, and compliance teams, so please stay with us till the end. We begin with important updates under the Income Tax Act. The Chennai Tribunal, in the case of Scientific Games India Private Limited versus Deputy Commissioner of Income Tax, delivered an important ruling on the tax treatment of finance lease transactions. The tribunal held that where the assessee was not the owner of vehicles taken on finance lease, the principal portion of the lease rentals paid could not be treated as capital expenditure. Since ownership of the asset did not vest with the assessee, the expenditure was held to be revenue in nature and allowable as a deduction. This decision brings clarity for businesses using assets under finance lease arrangements and reinforces the principle that ownership plays a crucial role in determining capital versus revenue expenditure. In another significant ruling, the Mumbai Tribunal in the case of Lakshman Kanayalal Dharmani versus Income Tax Officer dealt with taxation arising out of redevelopment agreements. The tribunal held that where the assessee surrendered his old flat measuring 623 square feet under a redevelopment agreement and, in exchange, received a new flat of 961 square feet, no addition could be made under Section 56(2) vary, even if the value of the new flat exceeded that of the old one. The tribunal clarified that such transactions are governed by mutual contractual obligations and do not attract tax merely because the area received is larger than the area surrendered. In another important judgment, the Mumbai Tribunal in the case of Raghavendra Ramakrishna Naik versus Income Tax Officer examined whether an allotment letter could be treated as a valid agreement for the purpose of Section 56(2) VIB. The tribunal held that where the allotment letter clearly specified the consideration amount, payment schedule, and conferred enforceable and exclusive rights, and where part consideration had already been paid through banking channels, such allotment letter constitutes a valid agreement. Accordingly, no addition could be made merely because the stamp duty value was higher than the agreement value. The Mumbai Tribunal also delivered a crucial ruling in the case of Income Tax Officer versus Godrej Agrovet Limited. It was held that where an assessee acquired shares from non-resident shareholders and deducted tax at source at the rate of 11.54%, which was in line with Section 112(1)(c)(3), the assessing officer was required to verify the remittance based on that rate. The tribunal clarified that the first and second provisos to Section 48 deal only with the computation mechanism and do not determine the applicable rate of tax. This ruling brings clarity to cross-border share purchase transactions involving non-residents. In another important case, the Pune Tribunal in Cummins India Limited versus ACIT held that disallowance made under Section 14A while computing normal income cannot be added back while computing book profits under Section 115JB. The tribunal observed that unless a specific adjustment is provided under the provisions governing computation of book profits, such additions cannot be artificially imported. This judgment provides relief to companies facing MAT-related disputes. The Delhi Tribunal, in the case of Ajay Pal Singh versus Income Tax Officer, dealt with penalty proceedings under Section 270A. The assessee, a salaried employee, had opted for a voluntary retirement scheme and initially declared the full amount received. Later, upon realizing that VRS compensation was exempt, he revised his return. The tribunal held that since there was no intention to underreport income and no loss to the revenue, penalty under Section 270A could not be levied. This ruling reinforces the principle that bona fide mistakes should not attract penal consequences. Another important ruling came from the Delhi High Court in the case of Dr. Manoj Khanna versus Income Tax Officer. The court held that where the managing director of a company was summoned for prosecution under Sections 276B and 278B for failure to deposit TDS, and the issues involved disputed facts such as the individual's role, responsibility, and existence of reasonable cause. Such matters could only be examined during trial. Therefore, the summoning order did not warrant interference at the threshold stage. Now let us move to the updates under GST law. The Allahabad High Court held that where a proprietor had died prior to initiation of proceedings and demand notices were issued in the name of the deceased person, without serving notice upon the legal representative, such proceedings were unsustainable in law. The court emphasized that statutory liability proceedings must strictly comply with procedural requirements, including proper issuance of notice to legal heirs. The Delhi High Court, in another important ruling, dealt with a case involving freezing of a bank account. The court observed that the petitioner had suppressed material facts, including an ongoing DGGI investigation and substantial availment of input tax credit. The bank produced a valid provisional attachment order. An inspection revealed that the business premises were non-existent. In such circumstances, the court refused to interfere and held that the petitioner must pursue remedies available under the statutory framework. In a taxpayer-friendly ruling, the Karnataka High Court held that refund of unutilized input tax credit accumulated due to an inverted duty structure cannot be denied when binding precedents in the assessee's own case already exist. The court directed the department to grant the refund along with applicable interest, reinforcing judicial discipline and consistency in tax administration. The Delhi High Court also held that where a taxpayer had responded to a show cause notice for cancellation of GST registration by submitting rent agreements and return filings, and the department canceled the registration without considering these submissions, such cancellation was invalid and liable to be set aside. Finally, we move to important developments under other corporate laws. The Supreme Court delivered a landmark judgment clarifying the definition of a workman. The court held that merely designating an employee as a manager does not exclude him from the definition of a workman if he does not exercise supervisory or managerial powers. If the employee primarily performs routine or manual work, he continues to be protected under labor laws, irrespective of his designation. In another significant ruling, the Supreme Court held that corporate social responsibility must necessarily include environmental responsibility. Companies cannot claim to be socially responsible while ignoring their impact on the environment and ecosystem. This judgment reinforces the evolving interpretation of corporate responsibility in modern governance. Lastly, the Calcutta High Court held that where sufficient material existed indicating involvement of an accused in money laundering activities, and the twin conditions under Section 45 were not satisfied, bail could not be granted at that stage. The court emphasized the seriousness of economic offenses and the need for strict scrutiny before granting relief. With this, we conclude this week's comprehensive update on tax and corporate law developments. If you found this video useful, please like, share, and subscribe to our channel SNK and Company for regular updates and professional insights. This content is meant purely for educational and informational purposes and should not be treated as legal or tax advice. Please consult your professional advisor before taking any decision. Thank you for watching, and we will see you in the next update.